Welcome to the Development Journal. We are standing at a major crossroads where the abstract world of artificial intelligence research finally meets the cold reality of industrial scale. This is no longer just about clever algorithms. It is about a massive collision between radical architectural efficiency and the staggering physical demands of global infrastructure. As we track this evolution, we see companies like Amazon and NTT committing hundreds of billions of dollars to physical hardware. The team at NTT is aiming for a massive 5 gigawatts of power capacity. It is a level of investment that signals a permanent shift in modern computing. To secure these sprawling environments, NVIDIA is launching a new initiative called OpenShell. It aims to provide a fundamental security layer for autonomous development operations, protecting the automated systems that will soon manage our most sensitive codebases. This represents a significant step toward making agentic workflows safe enough for the most rigorous enterprise standards.
Considering those infrastructure costs, the engineering community is looking for any way to optimize performance. That brings us to the Mamba 3 release, which promises to slash state reduction by half while utilizing multiple input, multiple output decoding. Can these architectural leaps offset the hardware costs? We begin with the 5 gigawatt expansion at NTT.
This 2 times reduction in state size for Mamba 3 is a massive leap for inference efficiency, reaching performance parity with Mamba 2. By cutting the state from 128 down to 64, we are seeing high-performance models become accessible to organizations that do not have massive server farms. Boosting throughput by 4 times directly addresses the scaling bottlenecks that have been frustrating product teams for the last year. When we look at the 1.5 billion parameter scale, reaching 57.6% accuracy, it is clear that these architectural improvements are delivering tangible results for real-world applications. Solving complex rotational tasks like parity provides a theoretical foundation that gives developers more confidence in the reliability of these models. This is not just about raw speed. It is about creating a stable environment where artificial intelligence can perform consistently across various tasks without the usual unpredictability we often see. We should also highlight how this architecture utilizes exponential trapezoidal discretization to provide a second-order accurate approximation of the state input integral. It is a level of mathematical precision that gives these models an edge in complex reasoning tasks. But Vance, does this move toward matrix multiplication change your view on hardware?
This move to shift the model into a compute-bound regime on H100 graphics processing units via multi-input, multi-output decoding is a brilliant piece of engineering. By transforming state updates into matrix-matrix multiplications, the researchers have finally overcome the low arithmetic intensity of 2.5 operations per byte. While the throughput gains are impressive, we have to acknowledge that this requires specialized Triton kernels, which increase the overall complexity of the software stack. Using exponential trapezoidal discretization for second-order accuracy is mathematically rigorous, but implementing these specialized kernels on the hardware level is a significant engineering challenge for most teams. I am particularly interested in the theoretical equivalence established between selective state models and rotary positional embeddings through the so-called rotary positional embeddings trick. It provides a mathematical bridge previously missing, while the implementation of BC and QK normalization stabilizes training to ensure sub-quadratic inference on H100 units. Now that we have explored the internal architecture of the model, we need to consider the environment where these models execute. We are moving from pure math to the secure sandbox environments where these models will eventually act as agents, which brings us.
NVIDIA is finally addressing the deep-seated fears of corporate leadership with the launch of OpenShell at the Global Technology Conference 2026. By establishing a policy-driven sandbox runtime, they are providing what many call Layer 0 security for autonomous agents operating within sensitive development and operations pipelines. The inclusion of a dedicated privacy router is a strategic masterstroke. because it intercepts large language model application programming interface calls to strip away caller credentials. This directly prevents the accidental leakage of internal database credentials, which remains the primary nightmare for every chief technology officer moving toward full automation. We are seeing the agentic economy reach an industrial scale that was previously unthinkable, with companies like E2B already serving over 200 million sandboxes. This massive volume proves that ephemeral execution is no longer a niche experiment, but a foundational requirement for the modern enterprise software stack. While these business implications are clear, I wonder if the technical foundations can actually support this level of autonomy without catastrophic failure. Vance, how does the kernel-level enforcement in OpenShell change the security profile compared to the software wrappers we have seen used by developers in the past?
The shift to kernel-level enforcement using Landlock Linux Security Module and Seccomp Berkeley Packet Filter is where the real engineering happens. Unlike simple filters, these tools prevent agents from bypassing security hooks at the operating system level, creating a much more robust barrier than traditional application-level checks. I have some reservations about the declarative policy engine because it allows for hot reloading rules on active sandboxes without requiring a full restart. While this maximizes uptime, it also introduces a significant vector for configuration errors that could expose entire environments if the audit process is not rigorous. On the performance side, the benchmarks are becoming incredibly tight, with Blaxel achieving 25 millisecond resume times and Daytona hitting sub-90 millisecond cold starts. These specific metrics are what make ephemeral execution viable for real-time agent responses, especially when paired with specialized graphics processing unit accelerated sandboxes from providers like Modal. Even with these software optimizations, the sheer volume of millions of sandboxes requires a physical footprint that most providers simply cannot match yet. We have to move from the software and security layer to the massive physical data center expansion from companies like Nippon Telegraph and Telephone, required to host these millions of sandboxes.
Nippon Telegraph and Telephone is not just building warehouses. They are constructing the literal backbone of the modern world with a 5 gigawatt capacity goal. What strikes me as truly remarkable is that 70% of this massive 4 gigawatt development pipeline is already secured under strict pre-leasing contracts with major clients right now. This aggressive expansion is backed by some very serious financial momentum, as the company reported $2.4 billion in sales for the fiscal year ending in March. That represents a 30% year-over-year increase, proving that the appetite for massive computational space is growing faster than most analysts anticipated. We are seeing these high-density facilities pop up in critical economic corridors like Frankfurt, which is slated for 500 megawatts of new capacity, alongside major developments in Milan and Osaka. These cities are effectively becoming the strategic hubs of a global economy that is increasingly defined by how much data it can process. When you look at the total projected infrastructure cost of $120 billion, you realize we are witnessing a capital deployment on a scale rarely seen in human history. Vance, when you consider that price tag, does the engineering reality of these facilities actually justify such a staggering amount of investment from the markets?
The capital intensity here is actually quite terrifying when you break down the specific math provided by analysts at TD Cowen. They estimate that the artificial intelligence-specific shells alone cost $13 million per megawatt. And when you add in liquid cooling and advanced networking, the total price tag jumps to $30 million per megawatt. Much of that cost is driven by hardware density, specifically the next-generation NVIDIA GB200NVL72 racks costing $3 million per unit. Managing the thermal load and power delivery for these specific racks requires engineering precision that leaves absolutely no room for any architectural errors. My concern is that while the 70% pre-leasing rate looks good on a spreadsheet today. Any significant slowdown in artificial intelligence adoption could leave these companies with massive stranded assets. If the software utility does not keep pace with this $52 billion shell expansion, these specialized buildings could become very expensive monuments to overconfidence. This massive physical footprint is ultimately a bet on the long-term viability of the silicon providers who make these high-density racks possible in the first place. It is the perfect time to shift from the physical builders of the artificial intelligence era to the financial giants writing the checks for these components.
Moving from the physical structures to the companies fueling them, NVIDIA has just issued a staggering $78 billion revenue forecast for the first quarter of fiscal year 2027. What makes this 65.47% year-over-year surge truly remarkable is that it comes while reporting zero revenue from the Chinese market. This performance reveals an insatiable global appetite for artificial intelligence silicon that transcends traditional geopolitical boundaries, with $96.68 billion in free cash flow and a return on equity exceeding 101%. The company is operating with a level of financial strength that allows it to navigate these massive regulatory shifts without losing its stride. Looking ahead, the introduction of the Vera Rubin architecture aims to deliver a 10 times reduction in inference token costs. This massive efficiency gain is the specific catalyst intended to drive the next upgrade cycle for hyperscalers like Meta, ensuring that the company maintains its dominant position in the data center even as competition begins to intensify across the broader industry. Despite the competitive pressure, the analyst community remains overwhelmingly positive, with a price target of $268.43. That is a significant premium over the current price of $178.56, reflecting a belief that the long-term utility of these chips outweighs the immediate regulatory noise.
While those growth numbers look spectacular on paper, the market seems to be pricing in a much darker reality, trading at a forward price-to-earnings ratio of only 16.06. Investors are clearly discounting the stock value due to deep-seated fears regarding further regulatory escalations and the long-term impact of those heavy export restrictions. The high volatility reflected in a beta of 2.38 shows a violent tug-of-war between bullish earnings reports and bearish geopolitical news. With a relative strength index sitting at a neutral 51.81, there is no clear consensus on whether the current price represents a discount or a warning sign. I find the promised 10 times reduction in token costs particularly difficult to square, with their current net margin of 55.60%. Maintaining that level of profitability while radically slashing the costs for customers like Meta represents a balancing act that might be far more precarious than the recent earnings excitement would lead most people to believe today.
That brings us to the broader question of how the largest buyers are managing these escalating costs within their own balance sheets. As we shift from the supply dominance of the chip makers to the massive capital expenditures of their largest customers, we need to look at how a giant like Amazon is consolidating its position through a $50 billion partnership. Amazon is taking an incredibly aggressive stance to secure its future in the artificial intelligence race by committing $15 billion as part of a larger $50 billion strategic investment in open artificial intelligence. This move is designed to ensure that their custom Trainium chips become a primary foundation for the next generation of models. This massive deal provides a critical platform for Amazon Web Services to showcase its vertical integration. By tying their hardware directly to the most prominent name in the industry, they are creating a powerful flywheel that could significantly accelerate the adoption of their proprietary silicon across the entire cloud ecosystem for years to come. The underlying business performance remains robust, with Amazon Web Services reporting a 24% revenue surge to $35.6 billion in the fourth quarter of 2025. However, the gap between their 50.29% gross margin and their 10.83% net margin is striking. That narrow net margin really highlights the staggering operational costs required to maintain a global infrastructure of this scale. It is a constant battle to turn that massive top-line revenue into actual profit when you are simultaneously trying to outspend every other competitor in the high-stakes cloud computing arena today.
But those operational costs are only half the story when you look at the sheer scale of the upcoming spending. Management has issued a staggering $200 billion capital expenditure guidance for 2026, which represents an unprecedented drain on their financial resources that could easily backfire if growth slows. When you consider that their trailing 12-month free cash flow currently sits at only $7.70 billion, that $200 billion figure is genuinely alarming. The market is clearly expressing its concern, as the stock is currently trading at $208.76, sitting below its moving averages. With a neutral relative strength index of 48.44, investors seem to be stuck in a holding pattern. There is a growing fear that this $50 billion deal with Open Artificial Intelligence is more of a defensive necessity rather than a calculated offensive move to gain market share.
We are seeing a similar sense of caution across the entire technology sector as the largest players grapple with these massive financial commitments. That uncertainty makes it the perfect time to pivot from the high-spending infrastructure giants to Apple and their current struggle with oversold technical indicators and mounting regulatory headwinds. Apple is currently navigating a period of intense technical pressure that seems disconnected from its underlying financial health. The 14-day relative strength index has plummeted to 25.66, signaling a deeply oversold condition. This comes even as the stock has seen a 5.9% decline since the beginning of the year. What is truly remarkable is that this technical dip is happening while the company reported a massive net income of $112.01 billion. That represents a 19.5% year-over-year earnings growth, proving that the hardware giant still knows how to generate significant value for its shareholders. Analysts seem to agree that the current price of $248.96 is an undervaluation of the company's true worth. With an average consensus price target sitting at $295.44, there is a clear expectation that a significant mean reversion bounce is on the horizon. This potential for a rebound is backed by a fortress-like balance sheet featuring $98.77 billion in free cash flow. When you combine that with a gross margin of 46.91% following the launch of the MacBook Neo, it is hard not to see this as a rare opportunity.
Sloan, those fundamental figures are certainly impressive, but I find it impossible to ignore the liquidity risk hiding in the current ratio of 0.89. Having short-term liabilities actually exceed short-term assets is a rare and concerning position for a company of this size to find itself in today. Beyond the balance sheet, the regulatory environment is becoming increasingly hostile for their high-margin services division. New mandates in China are forcing commissions down to 25%, with small developer fees dropping to 12%. This directly threatens the profitability of the App Store, which has long been the primary engine for margin expansion. While the net margin remains healthy at 26.92%, these forced cuts create a significant headwind for future growth. However, the strategic manufacturing pivot toward India does show that management is attempting to de-risk the supply chain and maintain their 6.43% year-over-year revenue growth trajectory. Ultimately, we are watching a fascinating collision between massive infrastructure investments and shifting regulatory landscapes. As architectural shifts and legal mandates continue to reshape the technology sector, the balance between aggressive capital expenditures and operational efficiency will define the next decade of innovation. That concludes our look at the intersection of high tech and high finance. We saw how Mamba 3 is slashing state size by 50% to make inference viable, while NVIDIA is hardening the foundation of agentic development with OpenShell. These architectural leaps are the only way to justify those $50 billion partnerships. Sloan, do you think these efficiencies can actually keep pace with the massive physical build-out?
It is a delicate balance between the lean code of multiple input, multiple output decoding and the raw power of $200 billion capital expenditure plans. We are witnessing the true industrialization of artificial intelligence, where digital logic meets the heavy steel and concrete of global data center expansion on an unprecedented scale. As these systems grow more complex and the investments climb into the hundreds of billions, the human element remains our most vital anchor. Thank you for joining us as we navigate these technical and financial shifts together. We will be back tomorrow to break down the next wave of innovation. Until then, keep looking at the big picture.